Welcome back, everyone. This is episode 7 in our free Forex course, Forex in 5 minutes here at Limitless Forex Academy. So this video is going to be on how to trade ranges. They're very, very simple. They're a simple structure in the market. They're very easy to spot, but they also give a lot of potential ways to enter the market. So I'll go over them now. I'll go over on how to spot them. So let's just get straight into it, really. We've got Euro USD because we can see a clear range that's formed here this morning. Now, to spot a range, you'll see essentially it is moving sideways in a rectangle. To put it very simply, I wouldn't draw it with a big box like this. I prefer to draw it with two boundary lines, so the top boundary and the lower boundary lines, otherwise known as support and resistance. But the overall range itself is the structure. So as you see here, price has bounced between these two lines, forming a sideways structure, i.e. a range. You can see the top level was tapped multiple times, even more over here with these wicks. The bottom was tapped multiple times over here by these wicks and lows as well. Now, it's important to note that when we're doing a range or when we're spotting a range, we want to see both the top and bottom levels tapped multiple times. That means two or more at least, because otherwise it's not really a range. We could have two taps to the bottom and only one to the top. That means it's more likely to be a double bottom. Vice versa, if you've got two taps to the top and only one at the bottom, it's more likely to be a double top. So it needs to have two or more taps to the top and the bottom in order to be a range. And here, when we draw it, we'll draw our levels to the outer highs. So the candle closes, we'll draw the level to the candle closes. Now, you'll note here that I haven't done that on this particular high, but that is because by this point, we'd already had so many highs taken into account. And if I am now to adjust it up here, we then miss two of these highs over here, which were clearly the original range highs. So you see here, it taps perfectly dead on to these wicks, perfectly on this candle close. It's wicked a lot of times here. And then what this actually is a fake out, which will trap breakout traders or people who don't necessarily understand structure. So see some of our previous videos on that, especially the one on avoiding fake outs. That would have helped you here. Here, impatient buyers would have jumped in. Breakout traders, as I said, people who don't understand structure, they would have jumped in, would have been faked out, even though it looked like a strong breakout, but it didn't break structure because we didn't break these wicks. Price then pushed back down, tested the bottom of the range again, and then shot out. So this leads me on to how we can trade the range. Now, for ranges, you can trade from either the top or the bottom inside the range, depending on your plan. That means you could take potentially sells from bounces from the top of the range down, or buys from bounces from the top of the range up. Or you can also take entries on the exit of the range. So by that, I mean, if price breaks to the upside, breaking all structure notes, so that means these wicks had to be broken as well, which was what eventually happened on this push up here. We can then, as you see here, price retests and continues. This is one of the most simple ways to trade a range. Price then comes back down and we move on from there. This is one way. Alternatively, you could have price break down and out of the range, retest, and then go down again. And note here, that would mean we need to break all these wicks. Candles would need to break and close past these wicks in order for it to be a valid break out of the range. These are the two breakout ways of trading a range. You want to make sure that all the wicks are broken. You want to make sure all structure is broken, and then you can look for the retest. And then alternatively, as I said, you can trade within that range. Now, with a tight range and a small range on the 15-minute, I wouldn't do that, but on the 4-hour and the daily, even the 1-hour ranges can be good, especially if you've got a big range of pips between them. On this one, it's only a 10 pip range because it's on the 15-minute, as I said, and it's quite a tight range. But if you can get a big range on the 1-hour, the 4-hour, the daily, depending on your strategy, then you can take nice trades based off bounces within this range. Now, that is if you are sort of support and resistance or supply and demand traders because you trade levels. As a structural trader, I note that this range is a structure and the break of structure is what I'm interested in. So I don't personally take trades within the range unless we see double bottoms, things like that, which are, again, other structures in the market. But that is how we spot a range. That is how we trade a range. It's nice and simple. Thanks for watching. I'll see you in the next video.